Hey everybody, how's it going? Welcome to another episode of Doing Real Estate Smart, real estate education for common buyers and sellers. My name is Rick, and in this episode we're covering your mortgage payment. What does your mortgage payment actually pay for? This is a great question for those of you who have never purchased a home, and even those of you who own a home and aren't too sure what your mortgage payment covers. This is going to provide some clarity for you, okay? So when it comes down to purchasing a home, if you're not paying cash for it, you're going to end up getting a loan from a lender that helps you purchase the home. And then after that, every month you're going to be making your mortgage payment. Now that mortgage payment covers a few things, okay? So one thing it covers is the interest that's paid towards the lender. Now, when you purchase a home, you're going to be getting this nice amortization schedule, which is basically a breakdown of every single payment you're going to make for the next 30 years of that loan. So it's kind of nice, I guess. But you'll notice that in the first several years of that loan, about 70 to 80% of your mortgage payment is going towards interest. Yes, it's that much, really. It's mind-blowing, but this is how the banks make their money. So they're going to be getting that money either way. So you're going to notice that for the first several years of paying your loan, your principal isn't going to move much. So if you really want your principal to drop down significantly, you want to make extra payments towards your principal to drop it faster. You can actually drop the life of the loan in half by making 1 or 2 or 3 extra payments a year towards your principal. So just a little tip there. But so that's one part. That's one part of where your mortgage payment goes to, is towards interest. Another part is obviously towards your principal. So that's another part there. Now, the next few things are things that are added on to your mortgage payment in a way that the lender kind of secures their investment. So one thing is taxes, property taxes. So what the lender does is they look at the property taxes, they project the property taxes for the year, and then they go ahead and divide that by 12, and they incorporate that into your monthly payment. So every month when you make your payment, the interest and the principal goes towards the lender, and then the taxes goes into a escrow account or trust account where it's held until tax season, and then whoever individual is managing the account ends up sending the payment to the state for your taxes. So you don't even send the payment yourself. You'll get the statement in the mail from the state, but you literally just don't do anything, and this person who manages the account pays it for you. So another chunk of that is going to be towards your homeowners insurance. Now, the lender secures their investment by making sure that you are paying your homeowners insurance by incorporating it into the mortgage payment. So very similar to your taxes, the homeowners insurance payment goes into an escrow account, and at the end of the year, whoever's managing the account sends the payment to your insurance company. Now, there's a third thing that could be added on there. It just kind of depends on what type of loan you get. If you use the VA, this does not apply. The FHA and conventional, I'm not sure if USDA counts as well, but it may. But for sure, USDA and conventional. Sorry, for sure, FHA and conventional. This does apply for those too. Now, when you use the FHA or conventional loan, they're going to require you to put down between 3% to 5%. Now, that's good. You put that down and then go ahead and get your loan. But they're going to go ahead and make sure that you also pay mortgage insurance. Now, anytime you use the FHA or conventional, if you don't put at least 20% down for that purchase, you will end up paying mortgage insurance. And mortgage insurance depends on the price of the home. So the the higher the price of the home, the more you're going to pay on mortgage insurance. A mortgage, you could be paying up to like $200 extra on your mortgage payment. That's just going to be going towards your mortgage insurance. And what does mortgage insurance do? It protects the lender just in case you default on the loan. So if you do default on the loan, the the insurance company ends up paying the lender the balance on the loan. So it doesn't even do anything for you. It's just extra money you're throwing to protect the lender. So if you're military, always use the VA. If you're not military and you have to use FHA or conventional, if you don't have that 20%, then you will end up paying mortgage insurance, and it's just a situation you're gonna have to kind of stick with. So again, hopefully this answered the question of what your mortgage payment covers and what it pays for. If you like the video, go ahead and like it. If you want notifications of any future videos, go ahead and hit the notification button. We'll go ahead and subscribe with the channel as well. I'm going to be putting out these videos every month. It's Doing Real Estate Smart, real estate education for common buyers and sellers. It's just, real estate topics for anybody who doesn't really know about real estate. I'm a real estate agent out here in Colorado Springs, so I practice this stuff every day. So I just want to go ahead and just kind of spread the knowledge to those who are curious out there. You know what I mean? Anyways, any questions, any comments, feel free to leave those below. You can go ahead and go to the description down below and click on my website if you want to go there for more information. I have more videos there as well as information about Colorado Springs listings and so many other things. So it was great talking to you guys, and I'll see you next time.